Hey guys, Jonathan Rose. In this quick video, I'm going to show you one of the best trades that I know. It's not something I talk about very often because these trades trade throughout the year, but when they're the best is in the fourth quarter. So let me give you a little overview. This is also exactly how Carl Icahn started his career and became one of the top investors of our time. Directly from the New York Times, Carl expanded into arbitrage. He noticed a similar pricing inefficiency in closed-end mutual funds, which were almost all trading at significant discounts to the value of the assets they owned. Icahn's strategy was to buy into the closed-end fund, shake the tree, force management to liquidate the fund at a profit to the shareholders, but most importantly, himself. The trade's called closed-end fund arbitrage. Sounds really scary. It's super simplistic. The one thing I need you to know is what a net asset value is, the NAV. The NAV is the fund's per share market value. So if a fund has assets of $50 million, liabilities of $10 million, the NAV is $40 million. Think of it this way. Apple. If Apple was a mutual fund, but there's only Apple in it, the net asset value of the mutual fund is just whatever price Apple is trading at in the open market. That's the net asset value of a fund. Closed-end funds, open-end funds, ETFs. This is the easiest way to explain it. Open-end funds, guys, that's just like a mutual fund. I'm sure you own a mutual fund. Obviously, you know what an ETF is. Here's why closed-end funds present a really unique opportunity. The daily NAV is reported at the end of the close. Same as in a mutual fund, ETFs report NAV real time. The market price, the stock price of the closed-end funds do not equal their net asset value. In an open-end fund, the market price is always equal to the net asset value. In an ETF, the market price is always equal to the net asset value. So what this means is if a fund holds 10 different holdings and they own 10% of each one of those holdings, the NAV is just going to be the total value of all the companies divided by 10, the NAV. Closed-end funds issue stock that's separate from the NAV. So more often than not, the stock trades at a big discount to the actual value of the companies that they hold. 2 months ago, across all closed-end funds, the average was a 4% discount, but right now, it's down to a 9.5% discount. And it does that in the fourth quarter, which is why great opportunity presents. Where do we get the liquidity? It's market, supply and demand. Mutual funds, the fund provides liquidity. If you want to buy a mutual fund, sell a mutual fund, you go to the mutual fund company. ETF, if you want to do a trade in the ETF, hey, the market, supply and demand, right? Here's the kicker. Open-end funds are a $13 trillion business. ETFs are a $3 trillion business. Closed-end funds are small, $300 billion. Well, probably not so small to you and me, but they are small to institutions. So if a hedge fund or institution or an endowment, one of these places with $10 billion under management, if they want to allocate $100 million to a specific trade or $200 million, you can't play in closed-end funds. It's too small. They have to go to open-end funds, ETFs, stocks, options. So what this does, it presents phenomenal opportunity for retail investors. I have a ton to cover. This Thursday, I'm going to hold one webinar on how to do closed-end fund arbitrage. You can sign up. It's going to be at 6 o'clock Central Time, 7 o'clock Eastern Time. This one webinar will explain exactly the opportunity, how and why we should be taking advantage of it. If you can come, great, sign up. I look forward to seeing you there. If not, sign up. We'll send you out a recording. I'll see you Thursday, guys. This is a phenomenal trade. This is one you don't want to miss.